Welcome to the Power Exit Podcast. This show is dedicated to business owners who want to scale up, plan smarter, and prepare for the ultimate exit. We'll talk with M&A experts and owners who've been through the process to provide actionable advice so that you can sell your business on your terms and without regret. I'm John Marsh. Join me as we prepare to take control of your exit. Welcome to the Power Exit Podcast, where we help business owners take control of their exit so that they can exit their business on their terms without regrets. Today, we're diving into one of the most critical but often most misunderstood parts of the deal process, the quality of earnings report. Joining me today is Jeff Silver, a partner at Carr, Ingram, where he works in the real estate and transaction advisory group. Jeff's worked with countless buyers and sellers across the lower middle market, and he's here to help us break down what a QoE actually is, why buyers rely on it so heavily, and what sellers can do to avoid surprises and protect their valuation from the LOI to the closing. If you're planning on selling a business or advising someone who is, this episode is packed with practical insights you don't want to miss. So Jeff, thank you for being here today on the Power Exit Podcast. We should let the listeners know that you and I go way back. We were at the University of Georgia together. We also took a summer class at Kennesaw State University, calculus. We will not remind the listener of who got the A and who did not.
They may be surprised, by the way, that it was you got the A.
Yeah, that's right. That's it. Yeah. But we also had the opportunity to live together when we were both starting our career in public accounting. I was with EY. I forget what firm you were with, but you were much more dedicated at that point in your career to the CPA process. So, my friend, thank you for being here. Would love for you to give us a brief introduction on who you are, what you do with Carr, Ingram, and then we'll get into the meat of the podcast here about the quality of earnings. But yeah, just a brief intro would be awesome.
Yeah, thanks, John. I'm so glad to be here. We've known each other for a very long time. I never would have guessed that we would be here today after 25 years of friendship doing a podcast together. But first, I congratulate you on becoming a successful businessman. You've done great. And it's been great to obviously been able to collaborate between our companies on some work that you have going on that, we can be of great assistance to you. Just overall. And it's actually, it's a great sign of the growth that you have created with your own business. So kudos to you, my friend.
Well, thanks, dude.
Absolutely. So my name is Jeff Silver. I'm a partner here at Carr, Ingram, as John explained. We like everybody else in the industry today, we try to keep it short. We go by CRI. It's just one of those things. Everybody goes by 3 letters or whatever. But I've been with CRI now for going on 8 years. I'm actually part of what you would call M&A myself, because the firm that I did work at, which was AGH, Aaron's Grand Habiff, was acquired by Carr, Ingram back in July of 2017. So I've been part of the M&A, you call it just the process overall. I've actually also, in my personal life, having been a business owner at one point with my wife, who's a dentist, we went through a transaction ourselves when we acquired and sold our dental practice. So I've seen it on that side too. But as it relates to my career in Carr, Ingram, a lot of my career has been focused on working with real estate investors. But through that process, I was actually doing a lot of buy-side due diligence on real estate acquisitions. That really gave me a flavor of what acquisition due diligence could look like. And it's, the outside the box aspect of it, the creative thinking that goes into putting a deal together. So that's kind of parlayed over the years into, really that becoming also a big part of my everyday career. So I kind of call it have 2 brains and, that operate, on a daily basis when I'm working with real estate clients, or I'm working with, clients outside of that space. And, the spaces I focus on and, purely M&A would be, real estate, but, not as much because, really that's, call it those acquisitions and dispositions are a little bit more on the basic side. So I really don't require the level of due diligence. Although like I said, I have done a lot of it, but, truly in the transaction advisory and M&A space that I work in, on a daily basis, I focus on manufacturing and distribution companies. I've worked with contracting companies. I've done a lot of healthcare work. And when I say healthcare, it could be any type of physician practice, it could be behavioral health, it could be dental practice, really anything in that space. And then just, any kind of run of the muck type of other what falls into the other business services category. So, and with our clients specifically, a lot of our clients here at CRI, we get to see a lot of different things. And, it actually opens the door for us to a lot of advisory type of work because, being in the lower middle market space and out having those type of clients, we know that they're going to be transacting, right? And so, that effectively, I know encompasses the sell side, but we also do a lot of buy side, call it buy side advisory and transaction advisory services as well.
Yeah. That's great. So let's dig into that a little bit. That's kind of why we're here, right? Let's talk a little bit about what due diligence, transaction due diligence has, since we talked a little bit about the acronyms that you CPAs are so love so much. What is transaction advisory services, and specifically, what is a quality of earnings report, and when does that come into play for an M&A or a transaction?
Well, transaction advisory services is actually it's pretty widespread. I mean, I think a lot of times, when people hear about transaction advisory services, are like, in the basics, somebody who's really has never seen it or talked about any of the space are like, oh, you help people what? Help people what? Buy, sell businesses. That's what you do. And effectively, I guess in a big picture, scale, that is that is what it is, right? But there's so many aspects to it now, like, so you mentioned like the quality of earnings, which ties into which we would call financial due diligence. There's tax related due diligence. There is, internal operational diligence that can be done. There's post integration diligence. I mean, there's so many aspects to it, that if you look around and you look at, all these different companies, including public accounting firms, and just call it just pure consulting firms, they offer those type of services because deals are complex. There's a lot of moving parts to it, and there's a lot that can be gained by seeking out the right advisors and having we call it the right army kind of going into battle with you. But when I say battle, I want to use that term very, very carefully because the purpose behind all this is a friendly fire type of thing, right? Because we're trying to help our client or the party that we're represent to get the deal over the finish line. Okay. And so when we're talking about quality of earnings, kind of focusing on that, what is it? Why do we need it? What is this, you know, I'd say Q of E. What is that term? Why is everybody talking about it? Well, Q of E is effectively the language of a transaction. Taking that a step further, it's what I think of as the storybook of the company. It's the storybook of the target, right? Whether we're talking about a buyer or a seller, both sides, depending on size too. And there's some factors that go into this because QVs are very robust products. It's basically a full analysis of your company, okay, over a period of time. Typically, it's going to be from 2 to 3 years and including a TTM period, TTM meaning trailing 12 months, and so that's going to pump you up to really the most recent period of operations that, really drives what was going to be the perceived value of your company to a potential buyer or giving the idea of the seller what their company is worth. And, it's EBITDA. So basically, taking it a step further, okay, so what's in the QV? The QV is going to present your company on a normalized basis. So we're trying to figure out what the normalized EBITDA of the company, recurring EBITDA, right? Recurring EBITDA and recurring free cash flow. Well, those are very important things for both sides to understand, right? Especially if you're a seller and you've got a seller representative, whether it be an investment bank or a business broker, they're going to want to understand, what is this company creating? What is it producing? What is the long trend analysis? What are the numbers showing? Ebbs and flows, profit margins, gross profit margins, okay? Normalized EBITDA, as I said, vendor concentrations, customer concentrations, okay? Contracts, viability of contracts, and again, that can get very, very complex. I know we're going to delve into that a little bit more. Some will call like the red flag areas that pop out, but really that's what the story of the QV is, right? It's the story of your company, what normalized earnings look like, okay? And and basically putting it into presentable product, which can be used by a seller, the seller's representative, and for the buyer. Because if you're the seller and you're doing a QV, the buyer's going to want a copy of it. Okay. If you're if you're the buyer, you're going to do one regardless of whether or not the seller has a QV. Again, something I know we're going to talk a little bit about in a little bit here. So I'll stop it right there.
No, this is great. And, as we said in the beginning, it's nice just to get it all out of the table. We don't need to follow an agenda here, but I do want to dive in deeper to who is hiring Carr, Riggs, and Ingram or other providers to do a quality of earnings. From my perspective, we sell a lot of businesses to private equity firms. We sell a lot of businesses to strategic acquirers. And even individuals are going to do some level of confirmatory due diligence. But we are going to see a quality of earnings, especially at a certain size. So talk to me a little bit about who historically has been, and I'm going to lead the witness here, it's generally the buyers, right? Who historically has been commissioning or hiring Carr, Riggs, and Ingram to do a quality of earnings report. But then the importance of a seller doing that prior to going to market. So give me your thoughts on, who's hiring you, kind of what you're using and developing or delivering to the buyer and how that impacts the negotiation or the transaction. Does
Sure.
that make sense?
It does. It does. And I will say this, if it's a buyer, it could be a family office, it could be a PE group, it could be, a strategic buyer that we have a relationship with. Um, those are typically the type of buyers we're going to get, and we
Mhm.
see it's really a nice even split amongst those. We do have a lot of PE relationships. So again, when a PE call it has a platform that they're looking to obviously grow and have, do a bunch of add-ons to, you could be part of that relationships where you're doing the due diligence on the platform and then you're assisting with the add-ons as well. So there's a lot of a lot of good depth in those type of relationships too, because you understand kind of what the MO here of the investment strategy is too. So it becomes a very effective relationship there. Same thing with the family office. Although, really when you're thinking about these types of buyers, they have different as we use that term again, MOs here, right? So a family office, what we see a lot is they're more kind of thinking the longer term hold, where a PE is thinking maybe a 3 to 4 to 5 year and then turn it over, right? Then take the proceeds and then reinvest that, or create a different platform or go into a different industry, because everyone's trying to seek out where the most value is being created and pivot when necessary, right? And when it comes to the sell side, I would say it's really it's founders. I mean, a lot of what we're representing on the seller side is founder-owned businesses, right? And so, but the introductions could be our clients, right? Because CRI is it's a large firm. We're a top 25 firm. We've got 3,000 people. We've got you know I don't know the exact number, but it's tens of thousands. It could be 100,000 different clients, right? And so it could just be just from casual conversation about asking our clients, like, where are you at? Okay. What are your thoughts? Are you considering something? Has somebody reached out to you? And it's also, we have relationships with people like you or business brokers and in other investment banks out there. CRI has an investment bank in house, CRI M&A advisors. So
Hey,
we've
I
got
didn't
a
invite you on
relationship
this
there.
podcast to advertise CRI's investment banking.
Well, John, if if I wasn't a partner in this practice, I wouldn't be doing my own due diligence here and expressing, this. But I will say this: an important thing to mention there is that an investment bank, those relationships with people, with potential seller-owned businesses, as they're marriages, and so you're very good at developing those relationships and helping clients through that process. That's why I would like to link up with people like you who truly understand your clients and work closely with them. We've got a lot of great relationships with a lot of investment banks out there who look to us as trusted advisors too to help for the diligence process.
Yeah, you're part of the deal team, and it's an integral part of the deal team. So, we are working on one together, Marsh Creek and CRI. This business is attractive but rapid growth, and they will have great demand in the market. But we're doing a sell side quality of earnings, meaning we are going to market with numbers that have been reviewed by CRI and a quality of earnings report. We understand that will help us really command the market and avoid a retrade. So let's walk the listener through what that means, right? So we go to market with numbers that won't change, right? So we market the business for sale, and if we've done no confirmatory due diligence prior to going to market, our numbers haven't been reviewed by a CPA firm. So now, in this situation, we're going to market with numbers that won't change. Generally, in my experience, sellers are hesitant to pay for a sell-side quality of earnings until they have the right deal, right? But we are seeing that it's becoming more accepted, and it's more a best practice, right, to have some level of confirmatory due diligence, because that avoids, like we said, the retrade. Because the buyer will do a quality of earnings report. They will do due diligence. And here's the key. I've heard your partner, Jeff Hawkins, talk about this, and I want your opinion too. But if CRI is hired by a buyer to do a quality of earnings report, and you find something that is actually a benefit to EBITDA, makes EBITDA greater, you don't share that with the other side. You're not going to pay more to say, hey, by the way, I found this, right? How often do you think that happens?
You know, I'll put it like this. There is never a situation with any type of QV, whether we've been representing a seller or a buyer, where there hasn't been something. Okay. And I that may sound like a kind of a sales pitch right there, but the reality is that, when you're taking a consultative deep dive into the numbers of a company, and you understand, really how the deal process works, you're going to find something. Okay. The reality is kind of going back a little bit to some of the things you said there is that you're right. A buyer, regardless of what a seller does, a buyer is going to do their own due diligence. They're going to do their own QV. Now, if it's a micro site, let's call it a micro company, right? They may do a QV light. They may focus on just more of the high risk areas, your revenue, call it like revenue recognition, type of accounting and reporting, right? Because that's a big driver behind what? Behind the EBITDA. That just makes sense, right? But if we're talking about a full scale QoE here, the buyer is absolutely going to do that. Why? I mean, they're the one who's putting the cash out here. They're making the payment, right? So what they're wanting to do is make sure that, hey, we've gotten the table. We've signed an LOI with you guys that has an EBITDA number in it. Okay. Now that's not like a concrete agreement. You can back out of an LOI, but it is an agreement of basically, here's the EBITDA. Okay. Here are the terms of the deal. Here's how working capital is going to be calculated, which is a very important aspect of this as well. Okay. Because once you come to an EBITDA agreement, you get through due diligence, and let's just say there's no change, there's no retrade. Well, people think, well, okay, now we're in the clear. Well, income's working capital. Again, a whole different discussion here, but it becomes a very important part of this whole equation because there is a lot of back and forth. And I like to call it friendly fire, but sometimes it can be contentious. Okay. Um, but the buyer is absolutely going to do it. And what happens is when the seller does not do the same on their side, doesn't consider any type of due diligence or validation on their side. What they're telling the buyer is, one is, buyer seeing themselves, well, how how serious are they really about selling this company? Because there is a fiduciary, call it, it's almost want to call it a gold medal you get. It kind of is that stamp of approval, says, you know what, these guys are serious about their company. They're serious about going to market. They're serious about getting a deal done. Because John, I mean, if you just Google, what is the percentage of deals that actually close? I mean, you do it right now, and there's been 50-year studies done out there where only 25 to 30% of businesses that go to market actually close. Okay. And so you can imagine that businesses, sellers that don't do QVs with that small of a percentage of actual close rate, okay, you would say to yourself, I probably want to do everything I can on my side, follow as much as you can, follow the rule book as much as possible to make sure that this goes through. It's complicated though, John, because there's a lot of sophisticated buyers out there, okay? And they know that these founder-owned businesses, they're the best in the world at what they do for their business. They are. There is no doubt in my mind. I've met so many so far in my career, and they are absolutely the best at what they do, but they've never sold a business before. They don't know what it's like to go through that process, and it's a rigorous process. Even if you got the greatest business in the world, the cleanest accounting, the best of every, it's still a rigorous process, right? So, but what happens is if you're not doing anything to represent yourself and your numbers, the buyer's going to come in and say, well, we did our own. Here are the numbers. No, by the way, they don't match up to what you guys had shared with us. here is your new number, and here is that term, here is the retraded value of your company. And then the seller's like, well, what happened here? Okay. So there's that. Okay. It's what we call it's the element of surprise. And nobody likes surprises, especially when there's a lot of money on the line here. And this is effectively going to be the largest check, most likely, that a seller is ever going to get. Okay. And that's the other thing here that a buyer needs to, kind of take a step back and think about. It's like, you've got a great company, you've got a great business, a strategic buyer, a PE is going to launch your business, right? But they've done this 100 times, 1,000 times. So they know exactly what to do, how to do this process, how to make the right offer. And even so, the offer that they make, it's going to be a number again that you've never received before, amount you've never, and you've got that gold fever. Oh my God, I didn't realize it was worth this. But the reality is that they're telling you what they think it's worth. What if you did a quality of earnings study and you find out, you know what? We had a whole bunch of personal expenses we were running through the business that basically were driving our EBITDA down. Okay. We had all these one type of expenses because we wanted to invest in a new product that didn't work out. Well, those are running through your EBITDA, right? But nobody took the time to say, you know what? Maybe this shouldn't be counting against us. Okay. Because when we talk about the idea of what is recurring EBITDA, one time things don't count. Okay. One time personal expenses, family owned businesses, founder owned businesses, they're run a tax efficient, as we like to call it, right? So there are always a lot of expenses that are running through it, especially if you've not had an audit or review done, which I'm not telling the world you need to absolutely do that. If you need to have it done for whatever, call it internal requirements or external requirements, that's great. Okay. But if we're talking about middle market, lower middle market, there are a lot of companies that don't have audits or reviews done, right? So basically, does it mean that their numbers are wrong? Absolutely not. But what it does mean is that their numbers are not what we call deal ready.
Yeah.
Okay. And
Yeah.
that's the preparation side.
Yeah. Well, and let's go a little deeper than that because a good M&A advisor like us will recast those financials. We'll look
Yep.
at the one-time expenses. We'll look at those personal items. We'll look at the, like you said, the failed project or something that was failed to be capitalized, and we'll run through the P&L. But let's talk a little bit about what other red flags you see. A good example might be percentage of completion accounting, which is extremely common.
Yes. So actually,
Something
that
that,
was the example I was going to use right there.
yeah,
Yeah, because that
please.
is the best
Yeah.
one. That is the best one right there, right? Because I will say this: Carr, and Ingram (CRI), our TAS group, has probably done no less than 18 to 20 deals with contractors over the past 16 to 18 months. So it's definitely become a very, call it a hotter area. For many, many years, we didn't see a whole lot of activity with some here and there. And part of the reason behind that is because it's been hard for buyers to get their arms around percentage of completion. Why is that? It's an estimate. If you can't get comfortable with an estimation process or the validity of the estimation process, you're going to probably be less inclined to want to invest in it, right? But once strategic buyers and PEs get comfortable, well, then that's a different story. And that's why we're seeing a lot more activity in that space. But it doesn't mean it's not a very complicated concept to get your arms around. Even people who run the companies themselves struggle with the concept. And why is that? Because or it's percentage of completion, right? It's an estimation of where you're at within each and every job based on what? Based on a budget, okay, which is established at the beginning of a job. What the true cost of the job is going to be, a gross profit estimation, and this is all over. Could be in when we're talking about percentage of completion, you're talking about a long-term job, and the longer a job goes, the more potential for changes to happen. That change orders, change in cost, which changes recognition overall, right? And so let's just say you have a job that goes for 2 years, right? That's a long time for a job. Anything over a year feels like a long period of time, but 2 years, right? That's a long period of time for changes in the job to happen, right? And let's just say that when you're looking at a potential seller's reporting, you see that they have a gradual amount of revenue recognition because you're talking about percentage completion. You're earning the revenue based on the percent that is complete of the total cost of the job, right? So that's percentage completion. Let's just say you've got a moderate amount. So let's just say you've got a $20 million job that's 2 years, right? And so you're looking at this on a month basis. In the first 18 months of the job, you've got 40% of the job complete. In the last 6 months, you have 60% of the job complete. So all the revenue recognition is happening, and basically the majority of it's happening in the last 6 months of the job. What happened there? Okay, because, oh, by the way, most of that is going to be in the TTM period, which again, what we're talking about here, the trailing 12 months, that's the period where we're truly looking at to establish what's the value of the company. That's the EBITDA. That's the EBITDA that everyone is looking at to say, okay, this is what we're going to use times a multiple to establish what the value of your company is. Well, should 60% of that revenue really been in the last 6 months of the job when it's a 24-month job? And then you start to look at all the costs and all the invoice and all the monthly billings that have been done. You say to yourself, well, wait a minute. Wait a minute. There's a whole bunch of stuff here that's happening in these periods that's being billed in this period. Guys, we need to take a step back here. Okay, and we need to figure out what is the right period that the true revenue recognition should be happening in. So I will tell you this, John, we've had multiple situations where we've had to pull out millions of dollars, okay, from the TTM period to put it in the previous period, to put it into the right period, because there wasn't a lot of good communication between the project manager and the CFO of the company, right? They didn't have really good processes in place to handle change orders. There was really no true understanding of really what's the revised price on the job, right? And so it can become a very sticky situation. And that's where the reality really comes in here, right? And that's why, especially, and I will say I'm focusing on the contracting industry right now, is that if I were to tell anybody who is a contractor right now, if you're considering going to market, you better have a QoE, okay? Because the first thing they're going to focus on and first thing they're going to ask is, can I see your job schedules?
Yeah. Yeah. 100%. And that is a key focus area. I've sold several contractors, fire protection businesses, and the focus on the job schedules is intense, right?
Very intense. And it has to be, right? Because again, there is still a lot of estimation that goes into it. So you have to show a potential buyer that you've got the right processes and systems in place to effectively track, manage, and report on a job, right? Especially if you've got, call it a customer concentration, you're doing a couple of big jobs for one customer, okay? That increases the risk behind what's being reported here and the risk to a potential buyer, right? It doesn't mean it's a bad company. Not at all. Actually, it could mean it's a very good company, especially if it's a good, long-standing relationship that continues to churn out more and more projects and more revenue. Okay. But it does shine the light down. So again, it makes it ultimately that much more important.
Yeah. Interesting. Yeah, I appreciate that. And let's talk a little bit about what timeline and cost. And I don't mean to put you on the spot because I know it depends, right? It depends
Well,
on.
that's what I was gonna say, John. It depends.
Yeah, well, I'm not going to let you do that. No, it's easy. Um, so how long does it take from start to finish? Assuming the client's responsive and
Of
going through,
course.
but how long is the quality earnings report?
Sure. Well, timing is of the essence here, right? When you're
Yeah,
ready, when you've made the
absolutely.
decision, well, if we're talking about a seller here, when you've made the decision to go to market, it's time to move, right? And your provider, whether it be your sell side representative like yourself or the transaction advisory services group, we all understand that, you know, the right deal is out there, but we have to get this to market in order to figure out when that deal is going to happen and when that buyer, to connect that buyer with this company. So the reality is that your QB process should really take all information received should take no longer than 4 to 5 weeks max. And 5 weeks is actually the high side. We should be able to do this in about 4 weeks. Okay, 4 weeks is a good, healthy amount of time to do this in. And the thing about it is, too, is that the most important part of the process is communicate with all parties involved. That's how you're going to make this a truly an effective process. We always need to be communicating with the sell side representative, and we've done that throughout the process with you, John. We do it with other investment banks that we work with. It's important also when you have a finding, okay, is to communicate with the client and say, hey guys, let's talk right now. Oh, hey guys, it looks like we've got a mistake in the way you're reporting something. Hey guys, it looks like, we have something that's positive here too. It's not all negative. I don't want to cast that, but you talked about the idea of a retrade here. And really, it's retrades can happen whether or not you have the best service providers in the world. They can happen. They can absolutely happen because everybody is looking at it through their own lens. And I'm not saying the retrade will ultimately happen, but it becomes like a negotiation, right? Because again, everybody has their own views, but really what we're trying to target here, John, being the representative of the company who's either selling or buying, is to eliminate the element of surprise. Like I said before, nobody likes surprises. There's plenty of money going trading hands here. A seller ultimately is going to have a thought of what the value of their business is, and a lot of times it's going to be a pretty high number, and we understand that because they're passionate about their businesses, right? We do understand that. So there's always a lot of psychology that goes into this as well. But if we can eliminate the element of surprise as much as possible, then we're going to be able to get the deal to help you get the deal done.
Yeah. Well, the name of this podcast is the Power Exit Podcast, right? And we talk about a retrade. We've talked about it a lot of times
Yeah.
here at today, and it's something that absolutely happens. We want to eliminate or mitigate the likelihood that that's going to happen. How do we do that? One, we go to market with good numbers, quality of earnings. Board is a valid uh, tool in that tool chest. Another one is building the competitive marketplace, because these buyers, we want to think everybody's got good intentions, but they're professionals. So they're going to come to you with an issue that may or may not be legitimate. It most likely is. And they're going to use that to their advantage. If you don't know what the truth is and you're relying on their quality of earnings provider, their legal due diligence, their operational due diligence, then you're not exiting in a situation with power. You're not controlling the situation.
That's correct.
So, that's part of the reason we're inviting professionals like you here to understand what the value of going to market from a position of strength. So, how many? Let's say you guys do 100 quality of earnings reports in a year.
Mhm.
How many of those are for sellers and how many of those are for buyers, would you say?
So, it honestly, it depends what market cycle we're in right now. Obviously, we're in a very interesting market cycle right now with, yeah, with tariffs and just, call it some economic uncertainty really, making changes to what the deal world is looking like. But I would say at any given time, so um over the last I'd say over the last 5 years, I'd say on average, we're probably doing 60 to 65% buy side and 35 to 40% sell side.
And what do you think the average EBITDA range is, or the average EBITDA for a seller who's doing a sell side quality rose?
So, I would say probably in the range of, starting at $2 million is probably a good kind of baseline number. Again, we're talking, it also depends again on the complexity of the business here. But if we're just talking about John and Jeff talking here, which is a good basement number here, good bottom line number, $2 million. And I would say that we've done the average QV EBITDA size that we're doing being, lower middle market to middle market. We're representing clients anywhere from 2 to 3 up to 25 to $50 million in EBITDA.
Yeah, got it. And I asked you the question, you didn't answer it.
Well, I know, John. I'm just going to keep talking until we kind of get past it. Right.
So, we're hearing all kinds of things on what a quality of earnings report should cost. And with the rise of AI, there are a lot of providers out there who are saying, "Oh, we can automate a lot of this," and you know, you get what you pay for.
That's
Uh,
correct.
but we're hearing ranges between 40 and 60,000 on average for a quality, uh, reputable accounting firm to do this service. Is that reasonable?
I think that is a reasonable number. I think, 35 to 40 is a good baseline number. I will say this, we have seen, the idea of what a QoE is definitely become commoditized coming out of COVID. It seems like more people than ever are doing QoEs, not because they necessarily everybody knows how to do them or knows how to do them extremely well, but they see the importance of them. And so, what happens is it becomes a soup du jour and everyone's, really pushing for it. So I think what has happened is in certain respects, it has diluted the quality, right? When you commoditize anything, it dilutes the quality. And so, and with that, because they know that in order people I think you said this earlier in the conversation, you're starting to see the value behind it because they know it's a
Oh,
valuable tool.
yeah.
They'll
Oh,
try
oh,
to
hot.
call a premium
Walk,
bill or try to get a
oh,
premium
oh,
fee for what that is, right? And so
walk,
we have seen a lot of fee
walk.
increases, although again, it's market driven. When you have economic uncertainty, prices come down. When the market's hot, everything goes sky high. But what I will say is, and and this is a this is a very truthful comment. We have stayed consistent in our pricing, right? And so, because what that means is that when times are good or times are not so good, you want to be able to know that you're working with a party or you got a relationship with a party that is not taking advantage of either of those situations, right? They're just remaining consistent. And the key is also is education, John. Really, that's where this kicks off, right? I mean, you could tell somebody this price or this price or this price, and they honestly, because they've never been through a deal, or if they don't have a sell side representative, they don't know, right? So going into any conversation with anybody we're talking with, it's all about the education. It's not just if there's a representative we're talking to, they have the education of the company. Then it's just education about us. If there's no sell side representative or in the situation, then it's education about both. But one important thing that I will say here overall for anybody who's listening or anybody who's potentially looking to take their company to market is, the key word is preparation, and it's never too early to prepare. I'm not saying if it's 10 years from now, that may be a little bit too early. But if we're talking, 3 to 5 years, it's you know what? That's not too early to start kicking the tires, right? Start considering, what ducks do I need to get in a row here to make sure that I have a successful process, right? And the idea here is to reach out, okay? And what I always tell people is when I talk to people, whether it's at ACG events, we're sponsors of ACG. We go to a lot of the Capital Connection events. We do a lot of presentations with ACG. Whenever I meet people at these events, I say, you know, if I'm focused on specifically seller here is look, if you're ready, when you're ready, great. But don't just wake up one morning and say, I'm ready to go. Okay. Okay. Give yourself,
Hop,
the proper amount of time to plan. You're building your business was not built in a day.
I,
Okay. So preparation for going through a deal is not going to take a day. It's not going to take a week. It's going to take weeks. It could take months. Okay. Because even when you get past the due diligence phase, there's still time, plenty of time. There's going to be, between that time and closing, right? So it's not something where you just snap your fingers, but preparation is really key. Get your financial house in order, right? Know your numbers, truly know your numbers, right? Start talking, get an understanding of what a due diligence process looks like. Talk to your friends, talk to your accountants, right? Talk to your accounting firm. They could absolutely recommend people that have information and understanding of the space, right? To do yourself that favor, okay? Because it's a stressful process. So try to eliminate as much stress as possible.
Absolutely. We say to folks every 90 days, you need to be asking yourself, are you growing or are you exiting? And that doesn't mean that, you need to go back and forth between, but it's preparing for the exit. Like you said, the 3 to 5 years, I say prepare from day one. Build your data room, save all your corporate files, save all your customer contracts, put them all in a preliminary data room or a data room that can be shared with your M&A advisor, your CPA, the buyer at the right time. Because going through this process is intense and you have to focus on running your business at the same time because nobody wants to buy a business that's doing this or at least
that's
pay
right.
premium for business that does this.
John, you're spot on there, man. You
Well,
know what? That's spot on. I agree.
yeah. So one thing I want to ask you, we've got hopefully some listeners out there who are taking some nuggets from this conversation, but some of them might not be at a place where they can afford or justify a quality of earnings. Let's say they've got $1 million of EBITDA or $500,000 of EBITDA. What can they do from an accounting perspective uh, today to prepare for a successful transaction?
Absolutely, absolutely. And so, when we're talking about the smaller size deals, you're right. They may not want to spend the money, or they may not feel the need for it. Or even maybe their advisors telling them you probably don't need a QB based on the size of your business. But again, that's sometimes what we like to refer to as a defensive engagement versus an offensive engagement, where basically when you're doing the full QV, it's a robust company, it's got a lot of earnings into it. You're doing the full scale due diligence. You're on offense, right? Well, you can also do a defense engagement, and that's really the type of questions that, in getting to know call it the target or the people, the ownership of the company who are looking to sell their businesses, what type of game do they want to play? And when I say game, I don't mean like fooling around here, but what type of football game do you want to play, or do you want to play defensive, or do you want to play offensive, right? And so if maybe it's just maybe it maybe the defense is like, we'll take a look at your revenue recognition policies. We'll do a proof of cash, because what does cash tell you? Cash tells you what reality is. Cash doesn't lie, right? So this is the amount of cash EBITDA that your company is producing. So we can call it smaller consultative type procedures, okay, that don't require a full blown Q of E, but really give useful information, right? Um, I worked with I was advising with a smaller company about a year ago who got solicited. Somebody, a strategic buyer in their space, knew them, knew their business, wanted their business, and basically, they were trying to figure out, we were doing their tax work, we're trying to figure out, do I need a QV? So I talked to them. I said, look, let me take a look at your financial statements. Let me just take a look at your general ledger. Let's just make sure we have a full understanding of your transactions. We come to find out that basically he was, running things through the balance sheet that should have hit the income statement, and vice versa. So his true understanding of what his EBITDA was and what his potential buyer was looking at was off. But we didn't need to go through a full scale Q of E to tell him that. We could say, okay, here's what we found, okay? And here's what I want you to do. I want you to communicate back with the parties looking to buy your business. And I want you to, yourself recast based on our conversation. If you need me to help you do that, I can do that. If you want me to sit in with a conversation with you just to help you kind of walk through what we're seeing and explain, why this matters or why we think this is impactful for your business, whether, obviously we want it to be positive, right? And you make the decision whether or not you want to talk about things that may not be as positive to the overall equation here. But whatever you think, because remember, we're representing you, we're helping you here, and we want to help you get the best result. But the reality is that we can stand by your side through that. We don't have to do the deep dive into this. It's really whatever you want. We can play the defense, but really, that's important not only just for getting to and establishing what the true EBITDA is, but again, we were talking about working capital. Sometimes that's where it becomes very, very sticky here, and that could be a whole different conversation in of itself. But working capital is not just as simple as taking, current assets less current liabilities, right? There's a lot of negotiation that goes on there. There's a lot of analysis that goes on. There's a lot of fluctuation considering, depending on what type of business this is. There's seasonal aspects sometimes that need to be considered. So just having a representative there to who knows the space, who's done a lot of deals, who's seen a lot of things, just to converse with. If you don't want to do the QV, just, you know, reach out and connect with that kind of person, okay? And hopefully they're gonna be honest enough to tell you that you're right, you don't need a QV, but here's what I think we should do to help you.
Yeah, I think that's key. Raising your hand and asking for help. Um, a lot of folks I speak with, business owners, think that their business is golden because they're getting approached by strategics. There's a lot of activity from folks like me, but that doesn't mean that the transaction is going to be easy or that the buyer's going to overlook financial inaccuracies. You really need to control your destiny by going to market from a position of strength. And the most important thing there is good financials, good numbers that are defensible and accurate. We're just agreeing with each other there. And to your point, we are going to do a separate episode on working capital. Uh, you know, I, Maybe somebody on your team can join us, but I want to roll our sleeves up and look at funds flows, look at a balance sheet, because it is the most misunderstood concept. And you're right. It shouldn't be a negotiation. It is what it is.
Mhm.
But at the same time, it doesn't work that way.
It
And
doesn't. It doesn't. It
you
doesn't,
get
and
taken
it
advantage of if you're not careful.
It it does, and, in that conversation, we can also, when that conversation happens, and whoever, if you happen to speak with another colleague of mine or anybody else, the basics here is that what the seller needs to understand is that this deal is cash free, debt free, okay? But understanding that concept and how that might all tie into working capital becomes ultimately that much more important. Okay.
Yeah. Yeah. Well, and we don't want deals to fall apart in general, but working capital usually comes into play later in the game.
It does. That's where we
After
see a lot of change a lot of changes in what that final fund flow amount is going to be.
Yeah, and I think a lot of folks in my seat do a disservice to their clients by not mentioning it at the beginning, not going in and saying, "Hey, you need to leave some gasoline in the tank." The analogy
That's
that,
right.
the market loves of, when you buy a car, it's gotta be able to be driven off the lot. Same thing with this. So yeah, let's save that for another day because that is a long, detailed conversation. But the car rigs can help me explain that to the market. Jeff, this has been a wonderful conversation. What have we not covered? Is there anything that you want to mention about CRI, about sellers going to market, maybe even from a buyer's perspective, that a business owner should hear from someone in your seat?
I think the most, this may be a little reiterative, but I mean, again, preparation. I cannot stress that enough. And no matter how many times we talk to our clients about it, or we meet new people and talk to them about it, it's just something that falls to the wayside. And I can understand that too, because you're operating your business every day and you're doing everything you can to make help your business be successful. But I cannot stress how important the idea of preparation here, getting your financial house in order and getting the right people, on board to help advise you, getting your army set before you really get into this to make sure it's the right thing to do and it's going to be the right time for you and it's going to achieve right results for you. Because one other thing I'm going to say here is that this is a metric that I've heard is that after the first year, only 5% of sellers are truly happy with the amount of money they got. Okay. And that's a true statement right there. Penny wise, pound foolish. Okay.
Yeah. Well, and it's that's we talk about exiting your business on your terms without regret. Um, it's not easy to do. It's a challenging thing. You have to be emotionally ready. We tell folks that you need to be comfortable with the cash you get at closing, and the earn out, the seller no, the contingencies are all kind of gravy because those aren't guaranteed. Now we're going to do everything we can to strike. Anyway, I can talk for an hour. We don't want to.
As could I. As could
Uh,
I. As could I.
so Jeff, how if someone would like to get in touch with you to learn more, can you give them give our audience some information on how folks can get in contact with you?
Absolutely. And so, is it okay? Should I just share my email address? Is it okay to say that? You
Yeah,
can you can
of
you can
course.
email me at jsilver@criadv.com. I give you my personal guarantee. If you do reach out, you're going to hear back with me within the day, but no more than 24 hours. That's kind of my policy, my rule, just overall. You can call the office directly. I mean, I know a lot of people prefer to email these days, but my direct number is 404-835-1856. So please utilize that. I like to tell people again, it's an open door policy. All you have to do is really walk through it. Um, and the conversations, to help you out here as we're starting off, they don't cost anything because the goal here is to help you get to a place to make a decision. Okay. And that's not something you should be charging people or making them feel insecure about. And which basically prevents them from wanting to do it, right? So these conversations to help get you ready to the point where you're going to make that decision, they're free. So utilize that, understand it. It's important to really take hold of that concept, okay?
Yeah, that's awesome, man. Well, hey, I appreciate. Who would have thought back that our graduation in 2002 and living together for a couple years afterwards would have led to us doing work together, and I'm glad it has.
I
So
am too, man. I figured you would have been so sick of me not taking out the trash that you probably would never want to do business with me,
you
period.
never came out of your room. You were too busy studying. Anyway. All right, brother. Well, thank you so much.
Yeah.
Yeah, yeah. Thanks so much, Jeff. Pleasure having you here.
Thanks, John.